Welcome to Talk Tickers. Today we're digging into Embecta's latest earnings report because there's a really interesting story here, a huge disconnect between the headline numbers and how the market reacted. Let's break it down. Okay, so here's the puzzle right up front. On one hand, you've got the headline beat. Embecta posts adjusted earnings of 50 cents a share, which is better than the 46 cents Wall Street was looking for. Sounds good, right? Well, not so fast. On the other hand, the stock immediately gets hammered, dropping over 7% on pretty heavy trading volume. So what gives? Why did investors rush for the exits? To really get to the bottom of this, we've got to look beyond that one earnings number. The full report card for the quarter, well, it tells a much more complicated story. It's a real mixed bag. And here are those key figures. You can see that bottom line beat right there, that 50-cent adjusted EPS. But, and this is a big but, look at the top line, revenue. It came in at $264 million, which was actually a slight miss. And that's really where the concern starts to creep in. This chart just lays it out perfectly. That earnings beat, it was solid, almost 9% better than expected. But it was completely canceled out, just totally overshadowed by that revenue miss. Now, you might think it's less than 1%, what's the big deal? But for a company that's already facing questions about growth, any little slip-up on sales gets put under a microscope.
All right, so how did management handle this on the call? Well, they tried to pivot. They basically tried to shift everyone's attention away from that revenue softness and toward the things they are controlling, specifically shoring up the company's financials.
Their number one talking point was cash flow. And you can see why. They generated a really impressive $182 million in free cash flow for the full year. In this kind of economic environment, cash is absolutely king. And that's a number that definitely makes you sit up and take notice. And what do you do with a big pile of cash? You pay down your debt. And they did. They knocked off $184 million in debt, which brought their net leverage down to a much, much healthier 2.9 times. That's a huge deal because it gives them way more breathing room and flexibility. And they kept hammering this point home, talking about execution. Look, they're getting disciplined, selling off non-core assets, finally getting their big new IT system up and running, and, get this, massively boosting their profitability margins. All of that while still paying out the dividend. The message was loud and clear. We've got our house in order. We are controlling our costs. And for the big growth question, they pointed way down the road. They kept bringing up the huge opportunity with GLP-1 drugs, like Ozempic. They see their pen needles as a critical part of that whole ecosystem. This is their big, long-term growth story they're trying to sell. But here's the thing. Despite all that good news on cash flow and cost control, the market just couldn't get past one thing. They were completely fixated on a different story, a growth engine that looks like it's sputtering out. And this right here is the smoking gun. This is the whole problem. When management gave their guidance for the next fiscal year, they said revenue would be flat to slightly down. That's a killer. All the financial discipline in the world can't hide a forecast that shows zero growth on the top line. And when you dig into why, you see some really tough challenges. U.S. sales fell off a cliff in the fourth quarter. Their old-school syringe business is just shrinking, and they're getting into some pretty intense price wars over in China. The market added all that up and just said, nope. The growth isn't here anytime soon. And if you zoom out and look at the past year, wow, the picture gets pretty ugly. Embecta's stock is down a whopping 40%. Over that same time, the S&P 500 is up over 14%, and even the broader medical device sector is up almost 5%. So Embecta isn't just lagging, it's being left in the dust. Okay, so that brings us to the most important part for anyone looking at the stock right now. What happens next? This is where we get into our trade idea for the coming quarter. This is the multi-million-dollar question, isn't it? After getting beaten down this badly, is Embecta a hidden gem, a deep value play where the market is just wrong? Or are those growth problems real and permanent, making this a classic value trap that'll just keep sinking? All right, here's how we're thinking about it. Our thesis is that the market has gone too far. It has overpunished this stock for that weak guidance, and in doing so, it's completely ignoring the amazing free cash flow story and the fact they're paying down debt so quickly. The catalyst for a rebound doesn't even need to be huge. Because expectations are so incredibly low, just a little bit of good news, like signs that China revenue is stabilizing or any small early win on the GLP-1 front, could cause a massive shift in sentiment and force the stock higher. So the trade idea here is to go long with an eye on a rebound back towards what most analysts think it's worth.
So, putting it all together, given that powerful cash generation, their discipline with the balance sheet, and just how negative sentiment is right now, we think the risk versus reward here looks pretty attractive. We're calling this one an outperform. And of course, this is for informational purposes only and does not constitute financial advice.